Okay, good afternoon, ladies and gentlemen, and welcome to today's webinar session. My name is Emmanuel Akinola, market analyst at HFM Nigeria. I'm sitting in for Mr. Heritage Adisa today. He's currently, having a session somewhere and he cannot, make it right now. But, I'm here and we're going to have a great time, talking about this really important concept approaching economic events, approaching economic calendars. What do we need to see and what do we need to do when it comes to trading the global financial market based on, most of these events that we already have when it comes to, the market. And to a certain extent, this is a very interesting topic because to a certain extent also it's kind of controversial. Controversial in the sense that, there's a way you expect the market to behave oftentimes when it comes to economic event. And once once the market does not behave that particular way, we get so many questions saying, sir, you expect the market to go this way because that was bad. But then the market went this way. I don't understand it, and quite a number of things that always comes up when it comes to economic events. Don't worry, to a certain extent, we're going to explain most of those things to the best of our knowledge today. We're going to try to help you, understand the concept of trading high risk events or economic data in the market. Now, in the first place, why are we even paying attention to this particular, topic? Why is this particular topic relevant? I mean, that's one of the biggest questions that we should have. Why is it relevant that we're paying attention to, you know, economic data, economic events, in the market? Why can't we just trade, what we need to trade? Why must we also pay attention to data releases? I mean, if you understand the place of data releases, maybe you would then get the main idea behind trading it and how we can effectively and efficiently trade it as, an event in the market. And one of the major things that you must first understand when it comes to economic events and economic data in the market, it is that it's proof of whatever is being said to be happening, in the market. You see, data is majorly just proof, proof, proof. If I say to you today, take for example, I say to you, I am the best student, in my class. The question should be, what's the proof? Right? Or do you just take it for what it is and say, I trust Mr. Emmanuel. He cannot lie, right? So you trust him so much, you know that what he's saying is true. He's actually the best student in his class. I mean, to a certain extent, it's okay to trust the person, but do you know one thing you can even trust more than the words of a person? Data, reports. If I now bring my report card from school and, and I bring my result to you, and my result is actually showing that I have all round A's and that I have the best GPA in the class, then to a certain extent, you would believe whatever it is that I'm saying, that I'm the best student, in the class. So people cannot claim, it is easier to claim something, but it is better when you can back it up. So the purpose of paying attention to data is because to a certain extent, it serves as, proof, and also it serves as a benchmark to major decisions when it comes to this particular market. When it comes to fundamentals, which means paying attention to, information relating to policies by the central bank or information surrounding the countries to which we're trading their currencies or the assets to which we're trading, it is quite possible that there are quite a lot of things being said that might not be holding true in the market at a particular point in time. For example, you could ask someone to appraise the value of its, country's economy, and he or she says that he believes that the economy is doing so well, or the economy is currently superb, as the case may be. But you know that might not also be true. But do you know one thing that you might not be able to debate? Data. If I bring data to you and that data is a confluence to what I am saying, it means you can have faith in that particular discussion. It means, for example, if I say to you, do you know that the pounds, for example, is the weakest currency in the market? I mean, the question you ask is, what exactly is informing such information? And then I have to now begin to say, okay, because we saw the last claimant count data, which is the number of people who are filing for unemployment related benefits in the UK, it came in about 26,000, and we're expecting about 17,000. Also, I could also say, if you look at the last retail sales report of this particular nation, or if you look at the last CPI report of this particular nation, or if you look at the last interest rates decision of this particular nation, this, and this is the reason why I think pounds is a weak currency, or this, and this is the reason why I think AUD is a strong currency, or this, and this is the reason why I think CAD is a weak currency. Data to a certain extent is important to traders and to the general market because it serves as a proof. It serves as, a confirmation as to whatever the market believes to be true, on the board. And you see, the aspect of data and in terms of it serving as a proof is that it can only be better in your hand if you already have an understanding of market expectation. You see, market expectation in the first place is one of the most important things when it comes to economic events and data. And market expectation is what is the general opinion, what the market believes to be true. More or less like a general opinion, or what is available. To a certain extent, market expectation could be based on just a general opinion. General opinion based on what we are reading, based on what we are seeing on the board, maybe even based on, what is currently available. But market expectation is one of the most important aspects of events because to a certain extent, the market is not known to, react to what is known. You see, what is known can only form expectation. What is known cannot generate reaction in the market. What is known to the market can only be the basis for expectation. So we don't not necessarily pay too much attention to what is known. The market only reacts majorly to what surprises them. To a certain extent, that thing to which they've not seen, that thing to which they're not prepared for. So there is always an expectation, always at every point in time. It could be based on what is known. It could be based on a general opinion. It could be based on what is currently available at the time. But that is usually the basis of expectation. But then we must also understand that away from what the market has known or is aware of, there is also what is released, which in this case is the basis for pricing. You see, I'm going somewhere. And I'm going somewhere, and I'm trying to say is we literally just said that what is actually known is just simply a basis for, expectation. It's just simply a basis for expectation. It's just simply a basis for what the market thinks, about that particular data or that particular event before it eventually happens. And it is actually what is released, which is actual at the time. And what is released is simply a basis for pricing. Now, because you must understand that in the market, what we do is we price in moves ahead of time. And economic data, economic events, they are, it's a focal point when it comes to fundamentals. And once again, fundamentals deals majorly with economic policies, central bank events, central bank decisions, central bank, press conferences, anything that relates majorly to the central bank, to the economy, is what fundamentals is all about. And when it comes to data events, it goes back, to those decisions. And to a certain extent, what is released is not actually a trade decision per se. What is released is simply a basis of pricing for the market, especially when it comes to fundamentals. And when it comes to saying the basis of pricing in this particular regard means we could either be pricing in the basis of pricing, especially in the market, is only into three things. It is either we price a cut in interest rate, or we price in hike in interest rate, or we price in hold in interest rate. You see, everything when it comes to economic events data goes back to interest rate. Every economic data event that is important, which we'll also go to, because not all economic data is actually important. You must understand that there is always, a sitting committee member in every central bank whose major job is to decide what they should do with their policy, that is, with their interest rate. Should they cut interest rate? Should they hold interest rate? Or should they hike interest rate? Now, listen, I am not a sitting member of any of these committees. You are also not a sitting member of any of these committees. In fact, these committees are made up of mostly between 8 to 9, at most 10 people most of the time. I'm not sure, but at least most of them have 9 members. Now, these guys also cannot make abstract decisions capable of crashing the market. Crashing in the market in the sense that they just make a decision out of nowhere that nobody's expecting. The surprise factor is going to be too much for the market. It could, make the market go crazy. So to a certain extent, we've been given a basis to which they make their decision. And what they do to make their decision is they also want to see data. And this is why one of the most common concepts or one of the most common languages when it comes to, central bank events is they always say, oh, we are going data dependent. We'll see what data says before we decide what to do. For example, the BOE in the last meeting was saying that they need to see what data would say for them to decide what they're going to do with the interest rate in December. And which is why now, after we saw the claimant count, I think on Tuesday, or for example, I think it was Tuesday or Monday, in that particular headline, what we read was claimant count increases the odds of the Bank of England cutting interest rates in December, which is to say that the data in of itself is not the problem, but the data was giving us a pricing for the central bank. So because we know that, these committee members, as the case may be, they look out for what data is saying to make their decision, it means we can price their decision ahead of time. So pricing moves in the market, or pricing in the market means to, take a particular move in a particular direction ahead of time, even when it is not even close to that particular period yet. For example, most central bank meetings now are slated for December, as the case may be. I think the FED is in December, BOE is in December, as the case may be as well. But it is possible that the market starts pricing in now based on economic data releases. So data releases in the market are important because they are majorly a basis for pricing. They are not important for themselves. Inflation is not important for itself. Retail sales is not important for itself. NFP is not important for itself. Nobody cares about it as a data, but rather we care about it because it could be the basis for pricing either a cut in interest rate for the Federal Reserve, for the central bank, an hike in interest rate, or a hold in interest rate, which to a certain extent could be, a little bit. And you must understand that it is only weak data points or events, weak data releases, that would make the market pricing cut in interest rate. If economic data releases is poor, which means to a certain extent it is showing that the economy is not resilient anymore, that the economy is starting to loosen its grip, eventually to help the economy, balance itself one way or the other, the central bank will need to cut interest rates and the market will price in that ahead of time. So naturally, weak data, helps the market pricing maybe a cut in interest rate for the central bank, especially when it is so many weak data that maybe there's a weak data now today, and the next one also was weak, and the next one also was weak, maybe not even close to a session like that, but at least we're just seeing weak economic data points like that. It is naturally an avenue for the market to price in, a cut in interest rate. Cut in interest rate, and which would in turn weaken the currency. This will weaken the currency. And there's something I want to put in brackets here. I'm going to put in asterisk, which means we'll come back to it. And naturally, strong data to a certain extent, might, put the market to pricing either an interest rate hike or old. And the reason why I'm putting or old is because to a certain extent, most central bank are not actually hiking interest rates right now, except BOG, which is the central bank right now with the propensity to hike, which is not even looking likely. Most of them are just holding, and to a certain extent, that would also strengthen the currency, you know. You see, the reason why I'm putting star is because even if on the basis of the data, and it's a weak data, a strong data, and it either weakens the currency, or strengthens the currency as the case may be. The big question is, what would be the market's reaction at the time? You see, market's reaction to data is not giving. It's a conundrum that I don't understand, that people really expect the market to be so straightforward that when there is an economic data and it is good, they just expect to see a positive reaction in the market. Or when there is a bad economic data and it is bad, they just want to see a negative economic reaction in the market for currency. They just want it to be straightforward. Don't you understand the dynamic of this business is to the point that things can never remain straightforward? I mean, even if it is straightforward today and it is straightforward tomorrow and it's even straightforward the next day, you don't expect that it remains straightforward forever. The dynamics of this market is to ensure that every single point in time, there are going to be people who will be interested in buying, and there will be people who is interested in selling because it's a CFD market. It means I need a buy for me to sell, I need a sell for me to buy. There must always be opposite counterparty trades. If for a certain reason the market remains straightforward, then who is going to take opposite side? So both of us to believe that we could know economic data so much that once we see good, we expect that there will be positive reactions, or once we see bad, expect that we're going to get negative reaction. And then when we don't get it, we now feel like the market is manipulating our trades. I mean, to a certain extent, where do you think that exists? But yes, forget the aspect of the dynamic market scenario. Yes, we understand that if your data comes in positive, you expect positive reaction. If your data comes in negative, you expect negative reaction. But you must understand that economic data commands attention. It commands attention, and which means to a certain extent, you have millions of traders around the world who are paying attention to, this same economic data. And you must understand, it's a rush hour period, which means to a certain extent, there's going to be a lot of rushing in, a lot of rushing out. There'll be a lot of volatility, which means it's possible that we don't get to see the reaction we want to see immediately. Now, listen to this. Saying that market reaction is not given has a comma, but in the long run, the market would always move according to pricing. It means that in as much as an economic data could be, positive, negative, and you're expecting an initial reaction, and maybe you don't even see the economic reaction, it does not change anything. That in the long run, the market would always move according to pricing. You see, in the thick of things, at that particular moment, it is quite possible that the reaction you're expecting to see is not what you're getting, but don't forget that eventually the market will return back to that data and say, no, this data is good. We need to go in this particular direction. And which is why when it comes to trading economic events, as the case may be, it is either we trade before or we trade on or we trade after the event. Now, you see, because market's reaction is not given, is why there are three ways to which you can approach trading risk events. Because you can never be too sure. Even if it is shining green like this, you can't be entirely convinced. Some people don't like to hear the truth. But that's why when it comes to approaching risk events, it's either we approach it, before we approach it on the event itself, that is when it is released, or we approach it after. Now, the risk with approaching risk events before is not even a risk. It's the idea behind before is we look out for, previous releases and see where it has been. We look out for the current market environment of the data, and then we make a prediction going forward saying this is what we expect from this particular data, and we lock in that particular trade before the event. Trading on the event is saying that your hand is on the clock, on the buy or the sell, and once you see the data, you want to quickly enter into the market, trying to get in on the move as soon as the data is released. That's on the clock, like this on the event itself. And after means to wait, see, let the market do what it wants to do. Let us see the volatility, in the market at the time, and then after a while, we then see what the market is doing and then coming to a conclusion as to what we expect to do with that particular data. But you see, I mean, the on the event is one I don't even encourage. This one I don't encourage. You know why? Because spread naturally will be higher, the in and the out. You might be entered into, your trades at levels you don't even want to come in. So I might not advise the on, but you see the before and the after, they have pros and cons. And to a certain extent, nobody, or it's not really good practice for anyone to restrict you to one side, rather show you, the two sides, and then you pick one. To a certain extent, the before and the after is simple. In terms of pros and cons, for the before trade, the pro is if you're right, you catch big moves because of the initial reaction. Yeah, if you're right, if you enter a high risk trade, if you're right, you're catching big moves, like because the immediate push, boom, you're already in the market, so you're not really concerned about what's going on. So if you're right to a certain extent, you catch big moves, make so much money. The cons also is if you're wrong, if you're wrong, you might lose more than what you have accounted for as stop loss because of potential slippages. So if you're wrong with entering, your trade before, right? The pro is simple. If you're right, you'll catch big moves, you make money, But if you're wrong, you might lose more than what you've accounted for as stop loss. Yes, majorly because of price slippages. Price could jump your stop loss, not jump, but kick it a little bit down the can as well. So it's quite possible, which is one of the cons of entering, before. But for after, the after trade, the only pro, or maybe one of the major pro things that I think might be qualifying itself as a pro of entering after is you have time to examine the data, determine the direction, and enter without extreme conditions or volatility. This is one of the major pros of entering after, that you would have time. Like, you would have time. Let me put this one here. Yeah, this one. You would actually have time to examine the data, see if it is good or bad, determine the direction, see what's happening on the board, and then enter without extreme conditions and also extreme volatility. But the con here, you might miss out on big moves. One, you might not get an entry point to join the market. So one of the major, well, as a con of after is you might just miss out on big moves, because you're not there when the initial jump happened. You've missed out on that. And also, to a certain extent, you might be preparing for the next leg higher. So you're looking for, a pullback, or you're looking for a break and retest of a level. It might not come. So you might actually miss out on moves. But I mean, to a certain extent, the con of the after is a little bit better than the con of the before. Because if I'm wrong and I'm losing and I lose more than what I've accounted for, I feel like to a certain extent, it is even better to miss out, than to lose more than I've accounted for. But that's in my own opinion. It might not hold for you. And that is why we're explaining it, right? To a certain extent. So the onus is now on you, to decide which one you feel like, you hold better, or which one you think would work, better for you. You get the idea. So we have pros, we have cons, for entering either before or after. I'm not really going to encourage the on, but you can do either before or after. And it depends also on the level of risk appetite you have, your account size as well. It might determine what you would be looking to do when it comes to the market. I mean, sometimes I also do before and I do after. So I'm more of a mix. But if I'm going to gauge how much of before or after that I do, I think I do more of after than before, if I'm being honest, right? I do more of after than before, but I do try some before once in a while, especially markets where I feel like almost everybody believes the same thing. Maybe when the expectation on the market is very, very similar almost across board, then to a certain extent, that might, prompt me to do a before trade. But I think I do more of after, coming down, see what data says, and then look out for opportunities to which you could get into the market, maybe even in the long run, as the case may be. And this, to a certain extent, is the basis to which we consider economic data, right? We consider them majorly because they help us with pricing in, decisions for the central bank, as the case may be. And when it comes to, most of the market, there are some key economic events that, carries weight than the other ones. For example, inflation report. Anything inflation is important for all of the currencies in the market. Inflation, otherwise known as CPI, it's very, very important data. All currencies, inflation data is one thing that, we must pay attention to. Interest rate decision, also all currencies, interest rate decisions. you know, based on central bank event, all currencies also pay attention to this one. For the market, all currencies are affected by, interest rate, decision, right? And to a certain extent, unemployment rate and employment change, well, these are key events majorly for CAD. CAD is the one that releases majorly unemployment rate and unemployment change together. Very key data for CAD. NZD also releases similar, data. AUD also releases similar data as well. you know, um, this particular unemployment rate and employment change figure. Yeah, very, very important data for CAD, NZD, and also the AUD as well. Very, very important data, for them. Retail sales is majorly common for the US dollar, right? Retail sales, very common to US dollar. I mean, nowadays, I don't even know if people are still reacting to retail sales, but at least US dollar releases US retail sales. I think to a certain extent, card also releases retail sales. Pounds also, we get retail sales for the UK. I'm not sure about Australia and NZD if we get retail sales for them. It's not really common. It's not really common for AUD and NZD to have retail sales. Which other data? Euro doesn't really release retail sales. So even if they do, it's not that important, to a certain extent. So I might want to leave it at card and pounds. I'm not sure if AUD makes this list, but I know that, retail sales, at least for dollar, card, and pounds, they do get retail sales data, and it's quite important for them. Also, the big NFP majorly only for, what's it called? Um, the US. It's just economic data point. Also, the NFP is simply just unemployment rate, employment change also, which is the number of jobs added to the US economy. This particular data here is what non-farm payroll is for the US. It's literally just labor market statistics. So it's only the US dollar that, gets, that particular one. Which other key releases do we have in the market? Well, PMIs, key releases in the market that we also pay attention to majorly for the euro. It affects more of the euro, also affects more of the pounds, as well as, you know, um, the US dollar as well. Majorly Thursdays or Fridays like that, we usually get PMIs, as well on the board. Key economic data events for currencies, the euro, the pounds, and the dollar, as well. And then not just PMIs now, also ISM manufacturing and services. ISM manufacturing and services PMI. Just this one is just not normal PMI. This is like ISM, This one is only for the US dollar majorly. Very key events also that we pay attention to for the US dollar. Unemployment claims, well, also key events for the US dollar. Also, to a certain extent, GDP is the data that is released majorly. And those that react to GDP data, I feel like to a certain extent, pounds reacts to GDP. Also, AUD reacts to GDP, especially when it is their quarterly GDP numbers. Quarterly GDP numbers is something that AUD might also react to. I don't really know US dollar to react to GDP like that, but once in a while it could, once in a while. But I'm sure of the pound's reaction to GDP, also seeing AUD react to GDP as well. Mm, I'm not sure if any other currency also reacts to GDP like that. It's not that important, but I think, for these two currencies, they might react to, GDP on the board as well. Which other one am I missing out? Inflation, interest rate decisions, employment rate and employment change, retail sales, non-farm payrolls, PMIs, IFM material and services, PMI also just majorly for dollar. And unemployment claims, GDP, very, very important. Yes, claimant count for the UK, also very important. Claimant count. Um, the wages index, also very important for AUD, one of the key economic events for the AUD as well. Mm, let me see. Am I missing out on? Okay, maybe PPIs. I mean, PPI and PCE, PPI and PCE for the US dollar, to a certain extent, too, could be important. Now, listen to this. The reason why I'm pointing out this particular economic event is because they are the ones that will determine, what the market would price in for, the central banks of the nations that are involved. To a certain extent, like I said, it's about pricing, what the central bank is going to have to do with their interest rate decision. And to a certain extent, these economic data releases are some of the releases that this particular country's central bank would like to pay attention to make their decision. When it comes to the US dollar, inflation is one of the key proponents, for pricing in. Also, PCE, very important, PPI. But when I want to rank economic data prints for the US dollar, I will rank inflation, I'll rank NFP, I'll rank unemployment claims, I also rank ISM services and manufacturing PMIs, the normal PMIs as well, retail sales too, but at least to a certain extent, all of these are key events or economic data points that could, generate market reaction and market pricing, for these particular currencies in the market. And like I said, the idea is when they produce weak reports or weak data points, as the case may be, it produces weak currencies or weakens the currency that is being released for. And if they produce, positive prints to a certain extent, it improves the pricing of that particular currency and it strengthens, the currency on the board. This is HFM's economic calendar. And to a certain extent as well, most calendars, Forex Factory, which is very, very popular, the HFM economic calendar also, which is really, really popular as well on the board, for example, look at this. There's GDP for, euro, but it's usually not a market mover like that. It's not something that the market would want to, hold on to and say. So yes, some other data might have names on here, but I feel like GDP is maybe something that the pounds will react to, maybe not euro, for example, right? So now I was talking about this, and eventually there could be a lot of economic events, every single day, but to a certain extent, we try to also filter them out to the ones that are important because not every economic data is important for pricing. So we may filter here, you know, you can check today alone, you can check tomorrow, you can check this week, you can check next week. If there's anything in there, it will produce those reports for you on the board for you to pay attention to, right? But we can also put in a filter. The filter is number one, you can determine the countries you want to see because not just all of these countries important to me. So I might want to remove some, like Argentina. And I don't trade your currency. I don't trade Belgium too. I don't trade Brazil. You know, I don't trade Austria. I trade Australian dollar, so I trade Canadian dollar, but I don't trade Chile. I don't trade Chinese yuan, maybe even Colombia, all of this. So you might decide that you don't want to have them showing on your website as well. So you can decide to remove them. For example, you could just go to none. If you go to none, right? So you can just easily select it. Instead of selecting them, just go to none. Select it, which is, Australia, Canada, we have maybe the Eurozone. And you could also have something with France because of its affiliation with Euro and also Germany. And then you could also have, let me see, Japan, JPY. You could have New Zealand in there. You would also have the US dollar as well, the UK, and also the Switzerland. So this is 8 already. And then when it comes to categories of what you want to see, I mean, to a certain extent, you want to see something with central banks, economic activities, inflation, very, very important. This one, you can even tick everything here, just so that you don't miss out on anything. You can just tick everything so that you don't miss out on any relevant inflation or economic event. And then in terms of volatility, now volatility is helping you to measure how well it can affect the market. Now, if you set this one on yellow, for example, you set this to yellow, yellow is a low impact event. So it does not really affect the market. On the Forex Factory, it puts more concepts to that. It's low impact. So I don't really need to see the yellow ones. And also the brown ones to a certain extent too might not even offer too much, in terms of market moving, impact on currencies or other assets. So I might not necessarily need the yellow ones. I might just say, okay, just give me only the red ones, to a certain extent. Just give me the red ones. And I can say save changes for next visit. And I filter my results, And then by the time it loads up, it only loads up for me the high impact events for the entirety of next week. And it can start, and there's GDP for Japan, 1 a.m. in the morning, I think on Monday. Imagine waking up for this. Now, to a certain extent, the yen is not it's not a currency that reacts too much to data, not especially GDP. So, because that's why I listed all of this for you, so that you know which one you can actually put so much attention on. So, to a certain extent, I'm not going to be awake 1:50 a.m. looking for what's happening to JPY. But then look at by 3:30, which is 1 hour behind, which is about 2:30 on Monday. There's consumer price index for Canada. So this one I absolutely want to see, right? I want to see what this has to say because, all currencies reacts to inflation. This is what my attention. Also, on Tuesday, there's RBA meeting minutes, which is just to show us the things that was said during the last Reserve Bank of Australia's meeting. This one is not a data, it's an event. Also, it could be it could be market moving also as well. On Wednesday, the CPI for the UK, very, very important in the morning by 8 a.m. Now, don't worry. Listen, on the HFM website, the time is currently 1 hour faster than the Nigerian time. So just remove an hour. So this one that is showing 9 a.m. is 8 a.m. in the morning, not 9. All right, it's 1 hour in the morning, except if I've already changed the time to Nigerian time. And this is still Athens, Bucharest. So, but you can change it here to, I think, Lagos time or West Central Africa. So in case you want to just see it in Nigerian time, just change this to West Central Africa. And every time you're seeing now, you don't have to do -1 hour or -2 hours. It will be normal Nigerian time, right here. Oh, it has gone to, I want next week now. Yeah, next week. So you can see it is 8 a.m. in the morning. So this one now is Nigerian time. It has nothing to do with -1 hour or -2 hours or anything like that. So there's CPI on Wednesday for the UK, which is quite important. On Friday, ooh, look at Friday. Ooh. Well, Friday, we have retail sales for pounds, which is important. Composite PMIs for euro in the morning, also important. We have PMIs in the morning for euro between 9:30 a.m. and 10 a.m. PMIs, which is this PMIs that I wrote here, PMIs. We have some for euro in the morning on Friday. We also have some for pounds also in the morning, 10:30 a.m. on Friday as well. And then that of the dollar also on Friday. So naturally, Fridays are PMIs days. Not every Friday, but PMIs are always naturally released on Friday. So this is the week, and these are all the events that can potentially, affect the market. Now that we know economic events that can affect the market, we know what's it called? That it's majorly for pricing, weak data with pricing, central bank cutting interest rate based on expectation, and if it is a good or positive data, we're pricing a little bit of, old or potentially hike, but no currency, no central bank is hiking interest rate right now at this particular time. How do we approach this event, either before or after, as the case may be? The only way, to a certain extent, to approach any of these data points, the key ones that affect the market is, to a certain extent, you must know what the market is thinking about that particular currency at the time. That is, you need current fundamentals. Listen to this. You need current fundamentals of those assets. You need current fundamentals. Even if you are doing it before or after, you need current fundamentals. Where is this particular asset right now? I was saying it this morning on the VTF that the price was still coming back, and this is this. If I think you can even reach the SF, yeah, I'll be happy for you. But that's by the way, you need current fundamentals. One. Now, you now need the data when it is released. how does it affect current fundamentals? Does it change it? Does it, increase itself? For example, if the current fundamentals of a currency is bullish, for example, and maybe when the data is released, it was also positive, positive in this case, which means it aligns majorly with the current fundamentals of a bullish particular currency. Your decision at the time will be to look for how to buy this particular asset. I mean, this is good to buy, good to trade. I don't want to say buy because it depends on, strong and weak. Remember that a currency can be bullish, strong, and you are still selling the pair because it's on the other side. So I don't want to say good to buy. Rather, I'm saying good to trade. So because if it is strong and it is strong versus weak, it is buy. If it is weak versus strong, then it becomes sell. So we know that, right? So let's just hold on to that. But it's good to trade if, to a certain extent, the current fundamentals aligns with what a particular data is saying, right? Just give me a minute, guys. So if it also, to a certain extent, if current fundamentals is also bearish, and when data came out or when the event is released, you see it also to be negative. That's good news. That's good news. Good news. Negative. This is also good to trade. Superb to trade, Seth. If it is bullish, for example, in terms of current fundamentals, and eventually data comes in, negative, if it is a strong data, not a random one, a strong data, it came in negative, for example, this one, wait for additional information or pay attention to price action. To a certain extent, this one might require you to calm down because now there's a change, there's a difference, in what it used to do and what it is currently doing at the time. There's a difference. So once, even if this one is bearish and this came out positive, also is the same. So I'm just going to do the same here. If this is also bearish, it's the same. And this came out positive, for example, you know, it's the same. You just have to wait for additional information, or pay attention to price action. Because at this time, the market also will be wondering what to do. Should they hold on to current fundamentals or should they react based on, what the data has already, shown to them at the time? You get the idea. So one thing we must do is at the time, if there's a difference, between what we know, current fundamentals and what we're seeing, we might have to wait for additional information. But if there's a confluence, then it's good to trade a particular market, especially, in line with what we have just seen, in the market at the time, and also, excuse me. And if you're not interested, in trading even based on fundamentals when it comes to risk events, maybe you're not that grounded in fundamentals, for example, because right now you need to know about current fundamentals. I mean, for those of us who are actually on the VTF, you absolutely know we ring current fundamentals almost every time. If you're not, I'm not sure if there are websites that can offer it to you ready-made, but don't worry, we're absolutely still going to assist you with it. We're going to talk more about, current fundamentals when it comes to the VTF. But even if you're not trading fundamentally and you want to trade based on the data itself, if a data comes out positive, you know, and you think, okay, this is a good data, and you've assumed that it is good, you need to go and find, a weak currency to pay it with. Pay it with a weak currency. I just told this gold to came down. He listened to me. Thank you, gold. Keep coming. Come, 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 come. There's a better level for you down here. Come, come. Anyway, so yes, if it also comes out negative, then all you need to also do is pair it with a strong current. So we don't even want to rush into, you just in the data is good. You just want to run into any kind of opportunity, any kind of pair. No, rather, even if it is good or it is bad, as the case may be, what we want to do is quickly find an opposite currency, which you can do on the market maker website, right? It's a strong data, it is positive, and you want to do something with it. You can quickly look for a weak currency and pair with, or if there's a negative data and you like what you're seeing, you can quickly look for a strong currency, to also pair it with on the market at the time, paying attention to, the concept of strong versus weak, offering us a buy, and weak versus strong offering us a sell, which means either you're positive or you're negative. All I need is to look for an opposite currency that can happen to you and make a decision to either buy, or to sell that particular asset in the market. And this is one of the major things to hold true to approaching economic events. And one more time, like I said, it's either you approach it before or you approach it on or you approach it after. But when it comes to economic event, guys, patience is key. Patience is important. Knowing what to do and how to go about it is as important as trading the decision itself. Please never forget that the idea behind trading is not to rush into the market. It's to make money. And if making money requires you to patiently wait for setup, wait for, market volatility and noise to die down before taking a trade, please absolutely, by all means, do that. Okay? By all means, do that. If you have a question, please put it in the Q&A right now. We are going to deal with them on the board. Gold does not have economic data. It relies on dollar for its own movement. What do you mean a data is positive or negative? If a data is good, it's positive. If a data is bad, it's negative. I mean, you can pay attention to the difference between, what is released and what is, expected for what data is good or bad. To a certain extent, it relies majorly on just rationality. For example, you're looking at inflation data. Well, according to the market, if inflation data is higher than what we're expecting, that is when it is good. If it is lower than what we're expecting, it is bad. But think, for example, you're getting unemployment rate data. If unemployment rate data is high, that's bad now. That's negative. If it is lower, that's positive. So it's just majorly to look at the data itself and know what makes it positive or what makes it negative. For example, retail sales. Retail sales is sales on the grassroots. If it is high, that's good news, it's positive data. If it is low, bad news, negative data. Think about GDP. If GDP goes up, it's good news. So your country is producing more. If it's going down, it is bad news. You're not producing more. Claimant counts, people claiming to not have jobs. If it goes up, it is bad. If it goes down, it is good. Unemployment claims, if it goes up, it is bad, negative. If it goes down, it is good. So you have to look at the data to know which side is either good or bad, either positive or negative. And I don't answer anonymous questions, please. Make sure you're working with your name. How do you pair weak and strong currencies for better decision? If you have a strong currency, you pay with a weak currency. If you have a weak currency, you have to pay with a strong currency. That means you need to know what is strong and what is weak. And to a certain extent, there are websites that could do that, but we don't like to, not this one, we don't like to use them in isolation, which must be that you have a context to which you're looking to trade it. Maybe you already have a strong one, maybe based on a positive economic data point. You need a weak one, look for a weak currency. Pay them accordingly. If it is weak versus strong, you buy. If it is strong versus weak, you buy. If it is weak versus strong, we then sell. You want to be trading gold alone. What exactly do I combine to trade gold? Just pay more attention to the dollar. Pay more attention to dollar, economic data points for the dollar, economic events for the dollar, and also geopolitics as well. That's majorly what you will need to trade gold, and also have a sharp technical analysis structure as well. So as long as you're technically sharp and you know a lot about dollar fundamentals, that could be good, for you to trade gold. What percentage indicates positive or negative data? We don't work with percentages. You don't work with fixed percentages. Albeit small, albeit big. If a data is positive, it is positive. If it is negative, it is negative. For example, this is, let me see what we had last week or this week, for example. One of the major reasons why pounds has been the weakest currency in the market this week is because of this particular data called claimant count. It's not necessarily a percentage. It's just a data. The number of people who are saying they don't have jobs, it says it is, it represents the change in the number of people unemployed. And the number of people unemployed or claiming not to have jobs in the UK before was about 0.4 thousand. We were expecting it, consensus, which was expecting it to be 20,000 people, but 29,000 people filed to not have jobs. This is bad. It's negative. So it's not by a percentage. It's by the data itself and what is being released compared to where it was the previous time. If people don't have job before, it's 0.4 thousand, and now it is 29,000. That's a very bad data. It's not a percentage. So it's not really percentage. Not all data are in percentage, and we don't have a fixed percentage to determine if a data is good or bad. What do I think about Euro USD? I'm so sorry, it's not an analysis class, but look out for the Telegram channel. I'll start posting what we talked about on the VTF this morning. Do you think gold will keep selling or we should take profit now? If you're currently selling, there might be some pullbacks, into that particular level of, what's it called? Support, into this particular resistance here, there might be this as a retest to push prices down. There might still be room to sell up to this point, but the onus is on you. I don't make investment decisions, right? So I cannot give you a straight line decision to either close or not, but there could still be more avenue for selling, given the fact that the market was able to breach this particular one, which is almost like a repetition of what you saw here, yesterday. After we saw this particular, move lower, we saw a quick retest of this particular level of, resistance, right? And prices dropped lower. That could also be the same case today. It has broken a key level of resistance. It's going to retest it, and there's a likelihood it goes down. But the decision to either close or hold is on you. Make that decision based on what I've just said. All right. I cannot offer straight line decisions. All right. But I mean, we've had a nice time in the session today. And yeah, thank you guys for joining us in the session today. We're going to see you now on the Telegram channel in a few minutes, posting some of the data charts that you need to pay attention to ahead of a fresh week. It was great having this discussion with you guys today. My name is Emmanuel Olalikon Akinola, market analyst at HFM Nigeria. Good afternoon.